Hey, good morning, everyone. Today is Tuesday, December 1st. So it is the first day of the last month of the year. We have 22 odd trading days left in the year, and 2020 has already been a wild ride. So we're gearing up for a very interesting close through the rest of the holiday season and into the new year. One of the themes that we've talked a lot about here has been the rotation between growth and value. We've seen equity markets really balloon over the last couple of months, but particularly dominated by many of the growth names. So throughout the pandemic, we saw a lot of technology companies shift their focus. Amazon completely dominated delivery. We had companies like Zoom Media that were also really participating in that stay-at-home trade, where we saw a lot of appreciation in the growth names, and growth just swamped value over the last. Really, it's been a lot longer than this year. It's been decades in the making. But very recently, we've started to see this little bit of a pivot between, towards that value again. So what I'd like to take a look at here this morning is a little bit of how we might play that in some of our options model portfolios. And so for our options model portfolios, we use the three major benchmarks of SPY, IWM, and QQQ. And we chose these three benchmarks because they're the most liquid names out there. And liquidity really matters when you're getting into options trades. The width of the market matters, where you can get that execution off, how much people are willing to come inside the market and potentially provide price improvement. The depth of the spread book is incredibly important there. The more active names that are trading several 100,000 to 1 million contracts a day, you're really going to have a lot of market participants in there that are able to take the other side of your trade. And that's really important getting in, and that's really important getting out. So we've chosen these three benchmarks because of their deep liquidity. So while we typically look to the S&P 500 as the biggest industrial names and the sort of flagship index in the United States, looking at a name like IWM or an ETF like IWM presents some interesting risk reward opportunities. So I'm going to go ahead and share my screen. As always, I will be pulling up my TradeHawk, and I'm going to pull up IWM right here. So this morning, IWM's up 1.3% to $2.40. Really the whole market's rallying. SPY is up $3.65. It's just over 1%, and QQQs are a little bit below that. They're up $1.84 or 0.6%. So we're actually really seeing that IWM outperform as of this morning. So a couple interesting notes here that I will highlight. Oops. Let me pull back up my TradeHawk. So a couple of interesting notes that I'll highlight here. One thing I'm looking at is the implied volatility. So if we're looking December, that implied volatility is 29 points. Going further out in the curve, that might flatten a little bit. We're seeing Jan at 28. We're seeing March in 27. A little bit cheaper, longer term dated vol. But that's long been a trend in the markets where we've seen this December, January vol, and even February to a degree, act relatively inflated. So that's going to be in that 27, 28 range, whereas a name like the QQQs is going to be closer to 23, 24 vol. So, those are those figures I'm looking at right along here. Really interesting to compare the volatility across the term structures, because that might give you an indication of what months are going to be a little bit more in play. Term structure volatility, open interest, depth, all these things come into play when we're selecting a strategy here. So, let's get back to IWM. And I think this presents an interesting comparison in terms of what kind of premium capture we can think about in a name like IWM compared to a name like SPY, and how that impacts the risk reward ratio here. So let me set up a little bit of our classic modify over here. So I'm going to sort of do a diversify structure where I'm going right at the money for these 183s. I might have a tight upside with the 185s. So now I've got 70-cent credit to play with. I might go all the way down to the 79 strike. So right now I am looking at collecting about 16 cents on this trade. The midpoint's 16, 17, 18 cents. Wide markets here. Beware, everyone. 4 cents wide, 10 cents wide, 1 cent wide. So actually, I'm looking at the December 4th expiration. I should be looking at the December 18th. It's going to make a lot more sense. I apologize for that. So going up to the December 18th expiration, we're going to do the 184s. We're going to do the 186s, and we're going to do, so I got 380 to play with. I got 2 points there. Maybe I'll look for 4 points on the downside, so go for that 180. So this actually makes a lot more sense in that we are going to be collecting about 60 cents on that trade. So, midpoint 60 cents, crossing that, you might get a 50 cents execution. Play in the middle there. There's likely someone that's going to give you some price improvement. So if I pull up my what if scenario on this and take a look here. So, a couple things that I'd point out, thinking about what it's like to trade this 30 vol name versus a 22 vol name. So, first of all, we've got that upside capture right there. So that's $61 upside capture. That's the amount that we collect on the trade. So I've said that execution is important. The price that you collect on trade really is going to matter. So that's that $61 that you're getting right there. Our downside is going to be 140 on the trade, 139 approximately. So, a little over 2 to 1 in terms of ratio of what our max downside is. But of course, we really like to set up these max profit zones. So looking out to December, we've got a nice wide max profit zone. And so that's another element of comparing a higher volatility name with a lower volatility name is your max profit zone is going to be significantly wider here. So, I've got a max profit zone that goes all the way from 186 down to about 182, it looks like. So that's a $4 max profit zone, which means in this $4 range between 182 and 186, I'm going to earn even more than the price that I collected on this trade. So if IWM does settle down around here, we really have some interesting max profit opportunities. Of course, the rally continues. We're going to collect that yield premium on the upside. So a couple figures I want you to keep in your head. I want you to keep that 61. I want you to keep that 139 and look at that sort of max profit bubble and kind of how wide it is. Higher volatility is going to widen that. Think about the benefit of selling a straddle that has a higher dollar price. You're going to collect more, and so your break-evens are going to be further and further away. So let's compare this to SPY. And I've got SPY up here. So, 29 vol in IWM we were looking at. Going out to December 18th, we're only looking at 17 vol here in SPY. Wow, that is low vol. Not as low as it's ever been, but we're really drifting down, and of course the rally this morning certainly helps that. So let's clear out this staging, and I'm going to set up a similar trade structure here in SPY. So going at the money again, making sure we're on that December 18th expiration. And if I go 2 points up, and I've got $5 to play with. So if I want to collect that same 60 cents, so let's sort of normalize here around that 60 cents number. That was the same 60 cents that we saw before. So now, notably, actually, these markets are a little bit tighter. So before I get into the what ifs, one thing I will point out there is SPY is still tighter than IWM. So most liquid ETF by far out there. SPY continually tops the charts in terms of options volume, but we're seeing that 62, 63 cents theoretical value with only about a nickel on either side. So, the market's 55 at 67, maybe it's 6 cents on either side. So, that tighter market is going to provide, a likely better execution. So something to always consider again. I know that's a point I like to harp on, but liquidity really matters when you are executing options trades. So let's pull up that what if now on the SPY, make sure I got it loaded. And here, so, one thing to consider is the $69 max profit. So that's actually going to be a little bit higher here. You've actually got a $131 max loss, which is going to be a little bit lower here. So, while you might be able to get approximately the same yield, maybe slightly more, your loss is actually a little bit tighter here. But a major difference is going to be this max profit zone. So this max profit zone is going to look a lot tighter here. So, we might go from 370 to 365-ish, but on a stock that's twice as expensive. So we have approximately the same range. It actually might be $1 more in SPY, but the stock is 50% more expensive. So in many ways, you're actually, your range ends up being a little tighter in these lower vol markets where that max profit zone is. Going for a higher volatility name is going to give you a little bit more of a interesting max profit zone. Let me compare real quickly to see if I pull that leg out just a little bit more. The other way. If I pull that leg in just a little bit, just to give you an idea of what that might look like. So collecting material less on that, 25 cents. But that risk reward now is almost 3 to 1. So if you want that kind of tighter market overall and aren't willing to risk as much, you're only going to gain $26 for that 74 and have a really tight, max profit window here. So one of the things to think about as you're constructing these different spreads is what is the overall dollar width that you're starting to play with. A $360 handle is going to be very different than a $180 handle. It's going to have implications on how big your max profit zone is. It's going to have implications on what your risk reward ratios are. So there are a lot of really nuanced factors to consider as you're setting up these structures. At Harvested Financial, we do all of this for you. This is our job, is setting up model portfolios exactly like this for our clients and rolling them as time goes on. For example, we set up a model portfolio a week or so ago that we're going to potentially be looking to take profits on early because the market has moved so much in our favor. When we initiated the trade, SPY was approximately $5 lower, and that gives us a profit-taking opportunity as the markets rallied, and we can roll into this. So a really interesting feature of this structure is the ability to rebalance it over time and adjust as the market's adjusting. So thanks so much for joining us. We're live here every morning at 8:35 Central, 9:35 Eastern to talk about options. But you can also check us out all day on our Twitter at harvested_DAFE. That's because derivatives are for everyone. Check out there for some great content. As you're seeing us here on our YouTube channel, tons of other really good information out there. And join us this evening for our webinar on model portfolios. And we'll get way more into detail about what these model portfolios can do for you over time and how they'll rebalance to keep you exposed to the equity and volatility risk premium.